Hello and welcome to this session in which we would learn about shareholders taxation when they are part of the S corporation. Simply put, how are the shareholders, the owners of the corporation, are taxed? So we need to learn about two topics. One is called separately stated items and the other one is non-separately stated items. And you're going to see this topic, separately and non-separately stated items, when we deal with partnership. Similar concept. Also, we need to be familiar with something called a Schedule K1. Is filled for each shareholder, so we're going to see the Schedule A1, to report his or her proportionate share of the S corporation income, loss, and deduction. Let's take a look at the big picture first. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our corporate income tax course is best for online students and students who are struggling in their corporate income tax courses. We cover C corporation, S corporation, partnership, as well as federal gift and trust. Our course include lectures, multiple choice, true-false questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
This is an 1120. 1120 is simply put the informational return for the S corporation. It's 1120 S. S stands basically the shareholders. U.S. income tax return for an S corporation. So the way it's prepared, very similar to an income statement. Think of an income statement. First, we report the operating income of the business. And let's assume the operating income is, all of it is 100,000. Then we'll deduct all the related operating expenses, compensation, salaries, repairs and maintenance, bad debt, rent, so on and so forth, and we'll have total deduction of, let's assume, 40,000. Now, income of 100, total deductions of 40,000, ordinary business and income is 60,000. So this is the ordinary income for the whole business. Then what we do is we're going to report this ordinary income to each shareholder. So each shareholder gets a K1. So let's assume, for the sake of illustration, this shareholder owns 50% of the corporation. Well, if this shareholder, and this is Farhat, this is me. Let's assume this is my share, Farhat. So if I own 50% of this corporation, what's going to happen? This amount, 60,000, 50% of it, which is 30,000, is reported to me as a shareholder. Now I'm responsible for paying taxes on this 30,000. Now, this is just a sample example, the big picture. Now we have other items that will be reported and we'll learn about those shortly, but that's the idea. The company report the items, then I get a share of that profit and I'm responsible for my own taxes. So this is the big picture. Now what happened if I own this company? I own this company 50%, but I did not own it for the full year. Well, here's what's going to happen. The shareholder, such as myself, would report his or her share of corporate income as of the end of the year. The amount allocated to each shareholder is determined on a per day and a per share basis. So the holding period of the corporate stock include the date of disposition of the stock, but does not include the date of acquisition. What does that mean? Simply put, if I have to take this 30,000, I own 50%, and I owned those stocks for only 90 out of 365. I only own it for 90 days. I have to prorate the time if that's the case.
Let's start with this simple example. Adam acquired 5% of XYZ Corporation stock on August the 15th, year 1. For the year 1, the corporation reported ordinary income of $300,500. It means they counted their revenues minus their operating expenses and they came up with $300,500. Determines Adam's share of this amount. Well, it's 5%. However, remember, Adam acquired the company August the 15th. Therefore, we have to be very careful in prorating the days. So Adam's share is determined on a per day and per share basis. Well, how does it work? Adam acquired the stock on August the 15th. Therefore, the holding period will start the following day on August the 16th. Well, here we have to count the days from the 16th till the end of the year. That's going to be 16 days in August, 30 days in September, 31 days in October, 30 days in November, and 31 days in December, for a total of 138 days. Now what we do is we prorate it. We're going to take the 138 divided by 365, multiplied by 5%, multiplied by the total ordinary income. As a result, we'll have $5,680 of ordinary income that goes to Adam's tax return. Simply put, if you want to take a look at it at a picture, well, what happened is this is the $300,500, of which Adam's share is, how much was it? Let's go back. Adam's share was 5,680. Therefore, when Adam gets his K1, he's responsible for reporting 5,680 of ordinary income from that particular year. Now, obviously, you might have other things. The same concept would apply on prorating this.
Now let's introduce the concept of non-separately stated item. What are non-separately stated items? Well, I'm going to tell you what they are. I'm going to show you a picture of them. Those are business income and business expenses that are classified as non-separately stated items. So what is non-separately stated item? Operating business income and operating business expenses that are bunched together. They are netted against each other. They are accumulated and netted against each other to arrive at a net ordinary business income or loss, which is passed again to the shareholder through the Schedule K1. And this is what I showed you. What are some examples of them? Well, ordinary income, ordinary expense items, non-separately stated items such as organizational costs, utilities, maintenance, wages. Let me show you what they are. Well, they're on the 1120S first page. Those are the non-separately stated items. What are they? The gross receipts from the business, returns and allowances of the business, cost of goods sold for the business, equal to gross profit, net gain other than net loss from 4797, total income, so on and so forth. So income for the business. Then deductions that belongs to the whole business, compensation of officers, salaries and wages, repairs and maintenance, bad debt, rent, taxes and licenses, and those are not individual taxes, those are taxes, certain taxes that the business pay, interest, depreciation, but that depreciation is not claimed on Form 1125A or elsewhere on the return, and we're going to see what that means later. Depletion, advertising, pension, employee benefit program, other deductions. So those are ordinary deduction for the business, and those are the non-separately stated items. So when you want to know what are the non-separately stated items, think of the income statement, revenues and expenses that deals with the business. Those are the typical ones. Now we need to talk about separately stated items and why do we have separately stated items. So it's important to understand why separately stated item exist as a category. Why? Because if you understand why, then you can recall them without memorizing them. Now why? Well, in contrast, other income and losses deductions are separately stated. Why? Because they affect each shareholder separately. Let me list them and I'll give you a few examples to make the point. Well, here are the separately stated items. And I'm going to use the example of Section 1231 gains. Section 1231 gains. What do we know about Section 1231 gains? Section 1231 gains can be taxed at 0%, 15%, or 20%. Well, why is that important? Why is that separately stated? Because we don't want to bunch, we don't want to include Section 1231 gains on the non-separately stated items and everyone gets the same share. And that's not true, because each individual is taxed differently on these items. So that's why we report Section 1231 gains and losses separately. So some individuals may receive, let's assume we have Section 1231 gains for the sake of illustration of 10,000, and you are a 50% owner. You're going to get 5,000 of that, and the other individual get another 5,000. Now, maybe for your 5,000, you pay zero taxes, because based on your tax rate, you're a 0% taxpayer, and the other individual will pay 20%. Well, why? Because depending on their tax bracket, depending on how much income they have. So notice it's treated differently for each taxpayer. That's why it's reported separately. Let's talk about capital losses. Capital losses, remember, capital losses, you can deduct up to $3,000 as individual of capital losses. Well, let's assume the company overall had $40,000 in capital losses. $40,000 in capital losses. If we bunched the capital losses with the other non-separately stated item, it's going to reduce ordinary income by $40,000, and everyone will take advantage of that. But if you're a 50% owner, you'll get allocated $20,000 of that, and of that $20,000, you can only deduct $3,000 because you're limited to $3,000. But if we take the $40,000, if we take this capital loss of $40,000 and we deduct it here somewhere, then it's going to be netted into the ordinary income, and you will be taking advantage of a $40,000 capital loss, which you cannot do as an individual. Same thing with charitable contribution. Each individual will have a different limitation on charitable contribution. Charitable contribution is a deduction. So we don't bunch this deduction with all the business deduction, because if it does, then it's good for the shareholders because now you're taking advantage of the deduction, but since each individual will have a different limitation, whatever charitable contribution we made, we report this information separately for each individual. Same thing with dividend, interest income, rental real estate, royalties, Section 179. So the point I'm trying to make is this. Why these items are reported separately? Because they affect each shareholder differently. Therefore, you don't want to bunch them. Now, obviously, I'm not going to go over each one, but hopefully you know that dividend income, same thing, qualified dividend will affect different individuals differently. Royalty and rental, depending whether you have a passive or active income, it affects you differently. That's why they are reported separately. Thus, we call them separately stated item, because we don't want to bunch them with ordinary income, then we would lose that effect in the grand scheme of things. Basically, if they got bunched, they will melt into the ordinary income, and they will be treated as ordinary income or loss for that matter, and that's not what we want to do. And on schedule form 1120S on page 3, what happened? If you'd like to look at one, they got reported. So here we'll have all of the net rental real estate income. Notice here the first one is ordinary income, I showed you. We will have interest income, we will have dividend, we will have royalties, we will have net capital gain, 28% collectibles, under-capture section 1250. So we will have all these items listed separately. Charitable contribution, investment interest expense, we have them listed separately as total. Then after that, for example, if you are a 50% owner of this company, 50% of these items are reported to you in these boxes. Then you have to treat them separately on your own tax return, because capital loss, how it's treated for one individual, it might affect the other individual separately. Same thing with charitable contribution, so on and so forth. So that's why we report them separately, because they affect each individual separately. We don't want to meld them. We don't want to lose their effect in the ordinary income. Let's take a look at an example. During year 2, Joanna, an S corporation, reported the following items: sales revenue, operating expenses, dividend income, maker's depreciation, Section 179 deduction. Determine the corporation business income and the separately stated item on Schedule K1. So as an individual, whether you are a CPA candidate, enrolled agent, or an accounting student, one of the concepts you need to know is which of these items should be separately stated, and which items they are non-separately stated. Non-separately stated means what? It means part of your net business income. Well, I would say sales revenue is business, operating business expense is business expense. I would say dividend income should be reported separately. Maker's depreciation, which is part of the business, is part of the business, means deducted. Section 179 is reported separately. It's a separately stated item. Therefore, the business income is $37,000 minus $15,000 minus the maker's depreciation. I'm not going to cover Section 179 in details now. I'll have a separate recording for this, but it's separately stated. On the other hand, we have dividend income, which again, we'll cover that later. Dividend income is subject to different tax rate depending on the taxpayer, if it's a qualified dividend, and Section 179 deduction of $3,000. Those are separately stated. Let's take a look at another example. We have this corporation, sales revenue of $200,000, entertainment expense 15, interest expense 10, maker's depreciation, rent expense, rental income. Let's take a look at those. First, we're going to start with the business income, sales revenue of 200,000 minus the maker's deduction of 6,000. Then we have rent expense. Now notice here, the rent expense is for the business itself, 179. Now entertainment expense of 15,000 is not deductible. Just make sure you're aware of that. In addition, the following items are separately stated on Schedule K1. Interest income of 10,000 because it affects individuals differently. Rental income of 17,200. So those are reported separately. It's also worth mentioning that S corporation income that flow through to the shareholder is eligible for Section 199A deduction, which is qualified business income deduction, which we'll talk about later. Just make sure you're aware that S corporation income is eligible for that, which is good, which will give you a nice deduction. What should you do now? Go to Farhat lectures and work additional MCQs, true, false. Invest in yourself, invest in your career. Take this seriously. It's gonna pay you dividend down the road. Good luck, study hard, and of course, stay safe.